And welcome to another Lumi Financial Corner. With us once again, Michael Zaremsky, head of U.S. Private Banking, Bank Lumi USA, member of the Investment Committee for Lumi Investment Services. Michael, good to speak with you again. How are you?
Always a pleasure, Zev. Everything's going well. Hopefully everything's good with you as well.
Thank God, thank God. So let me ask you, Michael, what's going on? Well, this week there seems to be a lot of volatility in the market. It's changed from last week. What's happening?
So, Zev, first off, let me say that the views expressed in this discussion are not necessarily those of the bank or the broker-dealer, but are my views. And, in short, I would say not a whole lot has really happened. When we look at how the markets have been behaving, and we've generally been on a fairly much a straight line up. And just to take a step back, I think that there's really been three drivers of market activity that we've talked about in the past. And those really remain the three main drivers going forward. We've talked about COVID, we've talked about fiscal policy, and we've talked about monetary policy as driven by the Fed. What we did see in the last week, again, particularly Friday through the weekend into Monday, was that for the first time in quite some time, the whole concern about COVID had shifted from a generally positive trend to definitely a much more negative trend, as we've seen Delta variant starting to kind of course through the nation and the world, and a lot more news attention focused on what that really means. There started to be some stories about out in California, maybe going back to indoor mask mandates, some places in Europe, maybe thinking about going back to slowing down or closing down or slowing down the reopening recovery trade. So again, I think that there was a lot of trepidations in the market, particularly when we were looking at markets where the equity markets have generally speaking been at or near all-time highs, and frankly, even today remain pretty close to all-time highs. So I think what we saw Monday was a bit of a pause because the COVID issue becoming a bigger factor. And I think what happened in the aftermath of that is a recognition of the new Delta variant is a bit more rampant. It's not necessarily leading to, significant increases in hospitalization or death or any of the other issues which were a major concern last year. And then again, I think that there was some mischaracterizations which happened early. And again, there was one comment from one of the health ministers in England where he inadvertently used some of the wrong data and then he later corrected it. And essentially what we're seeing now is that most of the Delta cases seem to be happening with people that have not been vaccinated. So again, I think that we saw a little bit of a pretty meaningful recovery on Tuesday when many people realized that some of the underlying factors that are still sustaining the market are in place. I do believe that it would be a very high threshold to start slowing down the recovery that we're seeing, particularly in a lot of the states that were very much opposed to shutting down or reopened early. So again, I think that we're probably still on a path, and I think a lot of the Delta variant stories, will have to be monitored closely. But at this point in time, I think that the equity markets in particular, and to some degree the fixed income markets, are also telling you that maybe the fears that we saw early on about where we go from here may be a bit overblown. So that really is kind of the cause of a lot of the volatility in my mind. And I think what we need to look at then beyond there is, what does that actually mean as we really look to move forward? And I would say that the two other elements that we have focused on and continue to focus on is what's happening with fiscal policy. The initial honeymoon that all new administrations have is clearly over in my mind for the Biden administration. The ability to pass legislation quickly through kind of the stroke of a newly elected president has passed. At this point in time, it clearly seems to me that every politician is really looking ahead at the calendar for November of 2022 for the next election. And any of the big contentious items that are up for bid in Washington right now will really have to go through the quote-unquote sausage factory of legislation and policy. So it's going to be a big haul to try to get anything passed in our very evenly divided government. And again, I think that the different factions within the Republican Party, the different factions within the Democratic Party will be mindful of everyone's own individual position. And again, I don't think it's going to be easy to pass partisan legislation. But the flip side of that is we've seen a tremendous amount of fiscal stimulus that's in the pipeline that will continue to be coming. It seems likely that there will be some infrastructure bill passed. regardless of whether it's 600 billion or 1.2 trillion or somewhere in between. So there still seems to be a significant amount of stimulus coming from the fiscal side of it, even if it starts to slow down. And that leaves us to, I think, what's the most important variable, which continues to be the Fed and central bank policy, so monetary policy. And I think also people need to remember that there's two main drivers of Fed policy. Their mandate is a dual mandate, which ties to price stability, which is loosely measured by inflation. And the other key element is employment. And we can all talk about anecdotal stories about inflation. We can all talk about situations that we've all encountered about employment, where people can't fill open jobs because there's not enough workers. And I think what the Fed has been clearly able to state in its laying out its calendar is the inflation in their mind is transitory. It really revolves around the kinks in working out supply chain management issues as we went from basically a very slowed down economy to a very booming economy. And what we do expect, and what the Fed has laid out, is that they do not expect to see stability in the employment markets until they start to see jobs reports from data in September and October. And again, largely speaking, most of the major school districts across the nation have spoken about schools being open in September. New York public schools are set to open September 13th. And many of the corporations that employ a lot of people in New York City are tying the back to work element to the back to school element. So we won't really get clear employment data until we get, deep into the third quarter or possibly early fourth quarter. So therefore, the Fed is pretty much on hold until we get some more clarity of data. So again, I think the key thing to focus on is what are these three drivers, which driver is leading at any given moment. And as long as COVID is not a driver, as long as instability on the fiscal policy side is not leading, we have a clear path that the Fed is going to remain accommodative. And that's going to bode well for, frankly, for equity markets and for risk assets.
So there we have it. So it stays the course, and sometimes you're going to have some adjustments, but pretty much if things continue the way they should be going, we should be in good shape.
And Zeb, I think, as we've talked about previously, if someone said to me, hey, we could have a 10% correction coming up, I certainly think that that's on the table. But as you saw with the rapid rebound on Tuesday and into today, which is continuing, there's very little other options for managers to place money. There's very little investment options beyond equity markets. With the monetary policy driving down interest rates to the level that they're at, with so much intervention from the central bank, the one area of the market that is the safety valve for assets remains equity markets. So I do believe that any sell-off that we've seen would likely see a pretty big response quickly, particularly because the economic data and the earnings reports from corporations continue to be really strong and really healthy. So if we start to see any wobbles in the economy, that would be a different story. But at this point in time, earnings seem to be strong across the board. Economic data continues to be strong. And I think as we've talked about previously, there's still over $2.5 trillion worth of household savings sitting on household balance sheets that in all likelihood will start to get deployed, which means spent, as we continue to move forward into reopening and recovery. So,
Michael Zaremsky, head of U.S. Private Banking, Bank Lumi USA, member of the Investment Committee for Lumi Investment Services. Thank you for being here with us. Look forward to speaking with you again.
Thank you very much, Sev, and look forward to speaking with you again soon.
And we're going to be right back. Don't go away. Stay tuned.